Rule number one is don't lose money, and rule number two.
Yep. Cash is
Me
trash.
again? Okay, cool. I was gonna
Cash
say
is
I was gonna
trash.
give it to you, but rule number two is don't forget rule number one.
Yeah. Well,
That's
hey,
probably,
I like that. I like that. So
yeah, that's the famous Warren Buffett
yeah,
line.
yeah, and guys
Uh,
and guys and girls. I mean, you're always going to see our Warren Buffett principles going in this because, um, you know, I believe and Dylan and I have you speak on this a little bit, Dylan. Is that I in my heart I think Warren Buffett is one of the best investors of all time. Just because of his principles, et cetera, and just his track record of investing from the 50s. And Dylan, you can kind of I know you've done some reading up on that. You want to expand on that a little bit?
yeah, sure. Documented. I mean, there may have been a investor in the 1800s or whatever that has a documented track record, but as far as I know, and as far as the field knows in terms of recorded track record for X period of time, where luck is essentially not mathematically not a factor anymore when you figure over the thousands, if not tens of thousands of investment decisions Warren Buffett has made. You can attribute maybe some of those to luck, but you can't attribute all of those to luck, obviously. And you look at his track record against the S&P 500 overall market, and you can say it's statistically impossible that he would just happen to be lucky. He just rolled over one time and just point on the newspaper and buy that, and then it went up, and then he did that like 800,000 times. That's just not going to happen by chance. So he's got the highest bar of public record that we know. The 20 whatever percent depends on what year you look it over. But that 60-year time frame is roughly 60-year time frame is the best. He's the gold medal. He's the best in the world essentially, as far as we know. So he's a good point to have a reference to whenever you're looking at your investment returns and all that kind of stuff. So yeah.
Yeah, and we're not. By the way, we don't work for Berkshire or anything. Well, it is just we're not.
No, no.
We're not. Yeah, we're not. We're not going for his buck or whatever. It's just somebody that we really appreciate and we, as Dylan said, see as the standard of of investing.
Yeah, for sure.
Okay. Now, the other thing I'm going to say is just out of caution. I think that is the right word to use. Caution for our listeners and viewers is that we don't want anybody putting any money into the stock market that you need for tomorrow. Please, please, just turn off this podcast right now. I mean, well, not turn it off, but you can practice. But we don't. I wouldn't feel comfortable having somebody put money into the stock market that they can't afford to lose. So anything we ask, please, please, please don't be doing cash advance on credit cards to buy stocks of our recommendations. I mean, you can.
Does work out sometimes, but not a good idea.
It does work out sometimes. We're not that type of people to peddle that, right? And we're not even going to peddle. We're not going to peddle you to do anything stupid with your money. Our main goal is to just educate people, have some fun, open it up, and really, frankly, in my own opinion, again, kind of go with the Dave Ramsey type thing, is that we want you to have a significant amount of savings in case you lose your job, or at least I want you to have a specific amount of savings.
Yeah, I
Go ahead.
36 months, 36
Yep.
months. Yeah, definitely fan of Ramsey.
Yeah. And again, another name you may come up, but with this is I think Dylan and I agree, and but it's all up on you. But you should have some type of cushion saved up before you even invest. When you say that, Dylan, you think say pretty prudent?
Yeah, absolutely. I mean, the Ramsey recommendation is 3 to 6 months of living expenses for whatever your average expenditures per month is. You should have 3 to 6 times that, and I think that's a pretty good rule. Um, I don't know how to go wrong with that. I think everyone should have that.
Perfect. And the other thing I want to say a little bit is that for specific, if you have credit card debts are normally at high interest rates, right? So pay off that credit card debt first, folks. If you are in that, again, don't use your credit card to buy stocks. Pay off that credit card first. It's a guaranteed. You're banging that out and don't just pay the interest, pay everything. Again, we're not really kind of looking to go that way in the podcast, but in all honesty, we need to get through the basics of, look, if you don't got money to invest in the stock market that you don't need for the future, this money's for the future, not
Yeah,
now.
go listen to Ramsey and get
Yeah.
out of debt and have some savings.
Thank you, thank you, thank you, have some savings.